Welcome to this guide on earnings calls and how to listen to company management. Earnings calls are one of the most valuable sources of information for investors. They give you direct access to what company leaders are thinking, how they view their business performance, and what they expect for the future. Understanding how to interpret these calls can significantly improve your investment decisions. Let's dive into what earnings calls are, how they work, and most importantly, how you can use them to become a better investor. An earnings call is a quarterly conference call where public company executives discuss their financial results with analysts and investors. These calls typically happen within a few weeks after each fiscal quarter ends, which means companies hold them about 4 times per year. The key point to understand is that earnings calls provide direct access to management's perspective on business performance and future outlook. Unlike reading dry financial reports, you get to hear straight from the Chief Executive Officer and Chief Financial Officer about what's happening in the company. They explain the numbers, discuss challenges, and share their vision for upcoming quarters. Every earnings call follows a predictable structure with 4 main parts. First, there's the safe harbor statement, which is a legal disclaimer about forward-looking statements. This protects the company from liability if their predictions don't come true. Second, executives deliver prepared remarks where the Chief Executive Officer and Chief Financial Officer present quarterly results and provide commentary on performance. Third comes the question and answer session, where analysts ask questions about performance and outlook. This is often the most revealing part of the call. Finally, management provides closing remarks to summarize key takeaways. Understanding this structure helps you know what to expect and where to pay closest attention. When listening to an earnings call, focus on 4 critical areas. First, revenue growth, both year-over-year and quarter-over-quarter comparisons. This tells you if the company is actually growing its business. Second, profit margins, including gross margin, operating margin, and net margin trends. These show how efficiently the company turns sales into profits. Third, customer metrics such as user growth, retention rates, and customer acquisition costs. These indicate the health of the customer base. Fourth, guidance updates, which is management's outlook for upcoming quarters. Pay special attention when they raise or lower their expectations, as this often moves the stock price significantly. Learning to read between the lines is crucial for interpreting earnings calls effectively. Pay close attention to management's tone and the language they use. Positive signals include a confident tone, specific numbers, and detailed plans for growth. When executives are raising guidance and discussing new opportunities, that's usually a good sign. On the other hand, warning signs include vague answers, deflecting questions, and excessive use of jargon to avoid direct responses. Red flags appear when management repeatedly lowers guidance or constantly blames external factors for poor performance. The way executives answer questions often reveals more than the prepared remarks themselves. Analysts typically ask 5 types of questions that reveal important information. They ask what drove revenue growth or decline this quarter, trying to understand the underlying business dynamics. They request more detail on guidance for the next quarter to get clarity on expectations. They inquire about how the company is competing against rivals in key markets, which reveals competitive positioning. They probe about the biggest risks and opportunities ahead to understand management's strategic thinking. Finally, they ask how operational changes are impacting profitability. Listen carefully to how management responds to these questions, especially if they seem uncomfortable or evasive with certain topics. Accessing earnings calls is easier than you might think. You can visit the company website and look for their investor relations section, which usually has live webcast links and archived recordings of past calls. Financial platforms like Seeking Alpha, Yahoo Finance, or Bloomberg provide transcripts that you can read at your own pace. Use earnings calendars on major financial sites to track when upcoming calls are scheduled so you don't miss important updates. Additionally, read the accompanying 10Q or 10K reports filed with the Securities and Exchange Commission for detailed financial data that complements what you hear on the call. Most earnings calls are free and open to the public. Let's recap the most important points. Earnings calls provide direct access to management's perspective, giving you insights you can't get from financial statements alone. Focus on key metrics like revenue, margins, and customer data, along with any guidance updates management provides. Listen critically and compare what management says to actual results over time. Some executives are overly optimistic, while others are conservative, so track their track record. Finally, use earnings calls alongside financial statements for complete analysis. The calls provide context and forward-looking information, while the statements give you hard data. Mastering earnings calls takes practice, but it's one of the most valuable skills you can develop as an investor. With time, you'll learn to spot genuine confidence versus empty promises, and that insight can give you a real edge in your investment decisions.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.